Hello, welcome back to week 8 of ECHO 360 International Economics. Our task today is really rather straightforward and maybe it's difficult really to go ahead and judge on behalf of students because you come from completely different backgrounds. But my guess is that this is maybe the most straightforward part of the course. We're going to try and limit this discussion as per the assignment, only really for a very simple, purely descriptive matter of the beginnings of trade policy. So to put things back in perspective, all what we're doing right now is we are moving from trade theory into the practical aspect of international trade. So trade theory, if you still recall, and I definitely hope that you do, possibly the single most important assumption is the fact that it's based on no trade barriers whatsoever. This is obviously, again, one of the reasons why is it that so many people object to trade or to the theory of trade by saying that it's based really on assumptions that do not exist in the real world. What that really simply means is that yes, we pretend that we're really talking all the time about free trade, and when you read the press and you hear the politicians, you think that we are living really in a free trade environment. But the fact of the matter is that there's never been really free trade, and probably there never will be. We had some very short periods of time whereby we had the freest period of trade for around 20 years or so in the latter part of the 19th century. But that's almost about it. So there are all sorts of barriers to trade. And as a result of these barriers, then all the conclusions that we have assumed up until now in all the trade theories really never become totally true, since all of these barriers are really artificial. They are created by us, by politicians, by the political systems. And so in this particular case, what are, do you think, the single most important and most common trade barriers? It goes without saying, as you well know, I tried to put a couple of words here very briefly so that you'll be able to keep track of the very simple discussion. The single most important thing really is that of tariffs. So we have tariffs in all forms. We have them as specific, ad valorem, or combined. Again, I mean, it's really a one-time read, so I don't feel that we need to go ahead and discuss things in great detail. But as you probably know, the specific is that when you say that the particular tariff is going to be, let's assume, $10 a unit. So every single unit that comes into the country will have to be taxed by $10. The ad valorem is that it's a percentage of the value of that particular commodity at its point of entry into the particular country. So you say, for example, that the ad valorem is going to be 20%. So if that particular item at the port of entry is worth $200, then the tariff would be $40. And then you have a combined, which is, by the way, quite common. You go ahead and assign a very small specific trade, and then probably another, and you add to it an ad valorem. This is very often done. I mean, in some cases, actually, there's one that comes to mind, will be fountain pens. Fountain pens, I believe the last time I looked at it, and things might have changed a little bit, but probably not by much, is that for the MFN, and we'll talk about it in a second, but for the countries that have the MFN, they pay, I believe, something like only 40 cents a pen, plus 2.7% of the value. The non-MFN will be taxed 6 cents. Again, that's not going to kill the proposition, but then the ad valorem, instead of being 2.7%, becomes 40%. So think in terms of, so that it becomes much easier to make sense of this, think in terms of an item or a fountain pen that is expensive, such as the Mont Blanc. Let's assume that you're talking about a, I don't know, $300 or $400 Mont Blanc. So in that particular case, the 6 cents and the 40 cents and the 70 cents or whatever it is not going to really make it or break it. However, the ad valorem, for those that have the advantage of being treated under the MFN, or what has become known right now as the NTR, then they pay only 2.7%, say 3%. So 3% of a $300, that's only $9. While the other countries will have to pay 40%. So 40% of $300, then that's $120. So as you can see, it is very highly discriminatory in nature, the idea of tariffs, if it's not applied uniformly to all countries. And historically, obviously, at one time or another, it wasn't really applied to all countries. This is obviously one of the advantages of the WTO, is to say that once you're a WTO member, then we will apply more or less a uniform form of taxation, of tariff, because tariff really is a tax, ultimately. And then if somebody is going to violate these provisions, which they used to be violated all the time under the old agreement, which was known as GATT, under the WTO, there is right now a recourse. You can go ahead and sue, and then the WTO will try to force a particular country to go ahead and abide by the rules. We'll get a chance to discuss probably some of these things later on in a chapter in around 3 weeks or so. But for the time being, I'm saying really, tariffs have always been with us and probably will always be with us. The important thing is that tariffs have really come down substantially, and in particular on manufactured goods. This has been the trend ever since GATT got started. And then we had the Kennedy round and Tokyo round and the Uruguay round. And for all practical purposes, the tariffs on manufactured goods have hit practically rock bottom. But the thing that has not, however, are tariffs on agricultural goods. And that was the basic goal of the Doha round. And ultimately, only around a year ago or so, there seems to have been a major breakthrough in the Doha round, which got started, by the way, right after 9/11. And that's why, by the way, Doha was chosen, because it was very easy to go ahead and protect people since Doha was on an island. So it took around 12 years, 13 years, in order to agree on a lowering of the tariffs on agricultural goods, so that we will go ahead and they will become as low as, for all practical purposes, manufactured goods. And that's, by the way, a very important issue, because who is it that benefits from a low structure of manufactured goods? Obviously, it's the industrial countries, i.e. the countries that are already developed, while the agricultural goods in general are the ones that will probably affect much more the developing countries. So the developing countries did not like the fact that all the emphasis was being placed only on manufactured goods. And so they demanded then that they get their chance also by lowering the goods on agricultural goods. And that's when the BRIC countries came together and sort of forced the developing countries to go ahead and listen to them. But yet, it was very difficult politically, both in the United States and in Europe, to go ahead and remove some of these barriers that were protecting the farmers. it is much more difficult, as probably many of you know from your microeconomics, to remove all of these protections on agricultural goods, because the price of agricultural goods, they swing quite a lot, again, because they are very both price inelastic and income inelastic. And so as a result, by the way, a bumper crop is bad for the farmer, and a good crop is good for the farmer because of this issue of elasticity. And so it is much more difficult politically to go ahead and remove some of these forms of protection. But to go back to this, then we've got to keep in mind another thing, which I'm going to do a very simple example. That's probably the most important part of this particular discussion for this assignment in week 8, is that there's a difference between what is known as the nominal rate of protection, when you go ahead and impose a tariff, whether ad valorem combined or specific, and the effective rate. The effective rate is completely different than the nominal rate, and I'll show you a simple example, and you have an example in the book, so probably 2 examples will be enough to clarify the proposition. The formula is very simple. All what you've got to do is keep in mind or understand the logic behind it, and then you'll always be able to recreate it. The thing that we want to also, by the way, eventually speak to is the fact that it is very dangerous once countries start fighting with each other using tariffs. Tariff escalation will always lead to some sort of a war, and everybody will suffer as a result. The best example would be really what happened between 1929 and 1931. As a result of the tariff wars between different countries, the volume, the value of exported goods dropped by around 75%. So you do something, you think that you're going to be helping yourself by offering that protection. The other country is going to retaliate by increasing its own tariffs, which will force you to go ahead and retaliate by increasing your own tariff, and then they increase theirs, and so on and so forth. And ultimately the tariffs will become so high that international trade will go down to practically nothing. And this was a very important element, by the way, in making the Great Depression as deep as it was, and as effective, and it affected most countries all over the world. In some cases, as probably you will know, unemployment went up to 30 or 35%, and it took forever to get out of it. Some people believe, and rather convincingly, that in the United States we got out of the Great Depression only by going into World War II. But this isn't the place to discuss this. The important thing is that you don't want to use tariffs as an escalation, because remember, essentially you're saying that the theory suggests that there shouldn't be really any barriers. So your goal should be definitely to reduce them and probably eliminate them if that is possible. So the consequences are really terrible. The important thing, and we're not going to deal with it graphically today, but we will deal with these things graphically next week. We will be able to show beyond the shadow of the doubt is that the world never gains, nobody gains from tariffs, not even the country that is imposing it. And that is the thing that you've got to keep in mind. What appears to be a protection really is in essence going to be reducing the level of welfare even of the country that is imposing the tariff. There is one exception, and again we'll deal with it next week in full details, and all of these are graphical models, by the way. We're not going to use any math except for the graphs, geometrical representation. There is something that is known as the nominal tariff, and there are exceptions, i.e. certain countries, such as the United States, by the way, that are very large and very powerful, economically speaking that is, whereby they do import a particular commodity or they are the major importers of a particular commodity, then these countries could impose a tariff that will be beneficial to them. But I must immediately add, there is no evidence that I am aware of that the United States has ever used its position in order to impose an optimal tariff. But even, by the way, in the case of an optimal tariff, the country that is imposing it might benefit, but the rest of the world will always lose. So the important consequence for tariffs, for any trade barrier, but right now we're talking about tariff, is that it will result in nothing else but a reduction in the level of welfare of the whole world and even of the country that is imposing it. That's to say, really, nobody benefits from tariffs. Now, the other few terms that we have mentioned, just to mention them one more time, MFN is the most favored nations status, and it has become right now known as NTR. So there is no longer an MFN. MFN, really all what it meant is that if you give a particular country a particular treatment, then all other countries that meet that requirement will get the same treatment. So MFN does not mean that you treat a country preferably than others, but you treat all of these countries together at the same level if they are going to meet the requirements that you set for them in order to get the MFN, which right now we call it the NTR. That's why, by the way, you keep hearing all of these things depending on your age. So these days, as I said, they don't use, the phrase is not as popular, although it still is used quite a lot in the press. That's why very many countries in the world spend a long period of time trying to obtain MFN in the United States. As a result of that example that I just gave you, because the United States says, okay, if you are an MFN member, then we're going to offer you this particular tariff rate. If you are not an MFN member, then we're going to charge you a much higher rate. So all of these countries, the United States being one of the largest markets in the world, then they would probably prefer for them to become competitive, obviously, to get the MFN. That's why both the Russians and the Chinese spent something like 10 years or even more before they really got the MFN status from the Congress in the United States. And obviously, as we all well know, once they got it right now, what they have conquered most of the, or so many parts of the American market through their exports, because right now they are treated equally to all other to all other countries. What are some of the other trade barriers? There is something that's called, I didn't get a chance to put it over here, there isn't enough room, called NTBs, we'll talk about it later on. The non-tariff barriers. The most important of the non-tariff barriers, by the way, are the quotas. So again, we will have to develop particular models for the quotas, but they're really very similar to the models that we're going to describe for the tariffs. So it isn't really a major deviation. Then there is something that's known as the VER, that's to say the voluntary export restraints. You go ahead and you ask the exporting country to reduce its exports to the country instead of one country increasing its tariffs. An excellent example of this, and again, we don't have the tools today because I haven't developed enough tools in order to talk about it, so we'll talk about it next week. But the VER, the best example really is that of cars. Under the Reagan administration at one time, the Japanese imports were doing so well and the American companies were suffering quite a lot. And they didn't want to go ahead and impose very high tariffs on the Japanese because that would have been against the WTO and against GATT and what have you. So President Bush went, I shouldn't say President Bush, Vice President Bush, because it was during the Reagan administration, this is Bush Sr., went ahead to Japan and convinced the Japanese. They told them very simply really, if you do not go ahead and put some restraints, some major restraints on the exports of your cars to the United States, then the American Congress would most probably be forced to go ahead and offer more protection by increasing the duties. So it will be much better if you will impose the restraint rather than to force us to go ahead and increase the duties. And that's what happened. And the same thing, by the way, happens in textile and in very many other kind of commodities. But it's a very interesting thing because it really works exactly in the reverse. The country does not increase its tariffs, but it's the exporting country that places the restraints. What's interesting about this, I don't want to put the cart in front of the horse because we'll talk about it, as I said, next week, is that, at least according to my perception of it, I believe that one of the major reasons for the development of the upper end of the Japanese cars, let's say the Lexus, the Acura, and the Infiniti, was really the VERs. So in that case, it really even backfired in the United States. So tariffs and all sorts of barriers never really benefit even the country that is imposing them most of the times. Before we go ahead and do this very small example about how to calculate the effective rate of protection, I must one more time spend only a few minutes to remind everyone, because this is going to become basic. That is why we're dealing with all of these formal models. For the next 3 weeks, every single one of these models, and we'll present 2, 3, 4 different models, all of them rest on the concept of measuring consumer surplus and producer surplus. So, in case some of you have forgotten your micro, in case some of you didn't get it the first time we spoke about it, so let me very briefly remind you of this one more time. If you have a demand curve and a supply curve, we say that at the point of equilibrium, let's assume that this is 100 units. We sell 100 units, assume, for example, at $10 each unit. But what does that mean if this is the demand curve? It means that there's an individual over here who's willing to buy the first unit at, say, $20. So if you're willing to buy it at 20, but you pay for it only 10, what does that mean? It means that you got $10 for free. That is consumer surplus. Now, the second individual is willing to pay 18. The third individual is willing to pay 17, and so on, but everybody pays 10, right? So if you add up all what these people would have been willing to pay, then that is consumer surplus. So consumer surplus, very simply, graphically, is the area between the demand curve and between the price that is paid. Because the demand curve is what? Is the price that consumers would have been willing to pay. But they pay only this particular price. So the area in between is consumer surplus. That is one of the magical issues about the market. So consumers, excluding the last item over here, are always going to really wind up with a particular surplus. But that's not it only. The important thing is that there's also a producer surplus. Because again, I hope all of you know this, but just in case you don't, the supply curve essentially is what really? It's nothing else but the cost curve for the manufacturer, for all practical purpose, right? Because what you're saying is that the supplier is willing to supply this quantity at this price, this quantity at this price. So this price must at least must cover all the cost. So anything that they get above this price is going to be a surplus. So this producer is willing to produce, let's assume, the first unit at $4, the second unit at $5, the third unit at $6, and so on. But in each case, they're going to be charging $10. So if you add up all of these surpluses, this becomes the producer surplus. So the equilibrium, the point of equilibrium, always, by the way, is the point of the maximization of both the consumer and the producer surpluses. The addition of both. That's to say, this cannot be an efficient point of production. This cannot be an efficient point of production. The only efficient point of production is over here at the intersection of supply and demand, because it's only at this point that the consumer and producer surpluses are going to be maximized. And I hope, again, that all of you probably have met something similar to this when you were talking about competition and perfect competition and about pure monopoly. This, you'll find out, is very similar, because really international trade is, for all practical purposes, until we get to finance, and unfortunately it'll be only probably the last 2 or 3 weeks about finance, but until you get to really to finance, it's really nothing else but an application of all sorts of principles of microeconomics. So, assuming this is true, let's see if we can spend right now a couple of moments about this idea of an effective rate of protection. The formula is very simple. It's V prime, that's to say the new resulting value added, minus the old value added, all divided over the value added. This is to say it's the change in the value added over the value added, which is really what the percentage change in the value added. So the idea is very simple. Let me give you an example of what that means. Let's assume that the world price for a particular item, in this case, what did I decide? I thought it was shirts. So the world price for shirts is $50. We impose a tariff of 20%. So this is the nominal rate of protection. So you would think that the domestic manufacturers would feel that they're going to be protected, get a 20% protection, right? Because all of a sudden, you're going to be, as a result of that 20%, all shirts that are going to be imported into the country at $50, they're going to have to pay $10 worth of a tariff. So therefore, they will have to sell for $60. So the domestic manufacturers right now can sell the shirts also for $60. So they feel obviously much better. Now, let's assume, just in order to allow this example to make a little bit more sense, that the shirts are obviously manufactured out of cloth, and the textile is also imported. So let's assume that every shirt requires $20 worth of textile, and that we're going to impose a tariff of 20% on the textile, of 10%, sorry. So in this case, we've imposed 20% on the imported shirt and 10% on the textile. Now, once we combine them together, what's happened right now to the protection of that particular industry? I mean, obviously, if anybody has looked over here, you already know that the effective rate of protection is going to be 26.6% in this particular case. So why is it that it's that much? What we do, again, we look at the value added. So how much was the value added prior to tariffs? Prior to tariffs, as you can see, we used to sell the shirt for $50. We used to pay for the imported material $20. So the value added is $30. That's to say you're a manufacturer. What do? You import $20 worth of textile, you hire a few people, and you pay the rent, and you pay your taxes and utilities and what have you, and you get $50, therefore you have added a value of $30. So you start with 20, you sell it for 50, so the value added is 30. Let's say what you have paid labor, profit, or other expenses. That's the value added. And as I don't know what are your specific majors, only 7 of you said that it was economics, but those of you, for example, in business, you know that one of the best ways of having a successful business is to find for a particular kind of an activity whereby you can increase the value added. That will allow you, obviously, to have a margin so that you'll be able to take advantage of that particular good. Now, what happens after tariff? After tariff right now, the value added is going to change. How is it going to change? Well, look at this. The shirt, the world price was 50. We're going to impose a tariff of 20%. So what is going to be sold at right now? It's going to be sold at 60, because we're going to have a tariff of 10 and 50, so it becomes 60. What about the inputs? Well, you used to import $20 worth of the material. Right now you're going to pay a 10% tax, so the value of the imported material is going to go up by $2, so it becomes 22. So you're going to sell a shirt for 60, you're going to import the material for 22, so the value added is 38. And now you take these figures, you plug them into this, and what do you get? Notice. So you get 38, the change in value added, 38 minus 30 is 8. 8 over 30 is 26.666%, i.e. 26.7%, say. So in this particular case, those shirt manufacturers that import their textile, therefore, are going to be getting an effective rate of protection of 26%. So it all depends. That's to say, if you are in a particular industry, it isn't only the rate on your product that is going to determine whether you're getting protection or not. There are other rates, in this case, for example, on textile, or on anything else that is going to be an input, that is going to affect ultimately the effective rate of protection that you're going to get. And obviously, by the way, you can work this example by changing these rates over here in order to make the rate of protection less than 20%. Or you can make it even negative for all practical purposes. So as you can see, there are very many variables. The important thing is to find out what is going to be the consequence of imposing a particular tariff on the value added of that particular. Because the value added is the room that you have in order to go ahead and make certain adjustments. In this particular case, as you can see, the tariffs have increased the value added. So they really have given the domestic manufacturers an additional $10 to $8 to play around with. It used to be 30 and it became 38. So in this case, they really benefited from this idea of introducing this. So I'm going to leave it only at this, and we'll get a chance to talk more about this next time by introducing graphical models for most of these issues that we have spoken about in order to demonstrate very clearly that tariffs do not benefit anyone. But that will depend, one more time, so that you'll be able to understand what we're talking about. They're all going to depend on this notion of consumer surplus. Okay, so with that, I will let you go and see you next week.